Hello everyone, and welcome again to Nettle, the best platform around for distance learning in business, finance, economics, and much more. Please don't forget to subscribe to our channel and click that bell notification button below so that you never miss fresh videos and tutorials you might be interested in. Many thanks to our current Patreon supporters for making this video possible, and we'd also greatly appreciate if you consider supporting us as well, so please check the link in the description for more details. My name is Seva, and today we are investigating the diversity weight approach of Fernholtz that is a blend between very well-known and commonly applied value and equal weighted approaches to asset allocation for passive portfolios. The logic is that you can combine both approaches and pick the best of both worlds for your portfolio. As an example to motivate our today's discussion, we have got all constituents of the S&P 500 index, all 505 stocks, and their weights in terms of their market caps. So these are value weights. These are the proportions of individual market caps in the sum of total market caps of the S&P 500 index. So if you were to replicate S&P 500 using your own stock portfolio or invest in something like an exchange-traded fund that tracks S&P 500, you would, for example, allocate almost 6% of your capital towards Apple. And one of the ways of solving this overexposure issue to large caps is to use exposure limits and derive your value-weighted portfolio with such limits straightforwardly, and that's what we investigated in one of the previous videos on the topic. However, blended diversity weights are also a good approach that one can use here. So first of all, let's compare what is the difference between your value weights and your equal weights. So we can just count how many stocks we have got in our S&P 500 constituents list, so 505. And equal weights obviously would just be 1 over the number of stocks. And let's just lock that and enforce it throughout. So in an equal weighted strategy, you will quite naturally allocate a lot less of your capital towards large caps. So 30 times less capital is allocated towards Apple in this case. However, you do allocate a lot more into relatively smaller companies. For example, 20 times more capital are allocated towards the News Corporation Class B share in the equal weighted case than in the value weighted case. The diversity weight approach of Fernholtz seeks to bridge the gap between those two weighting schemes and calculate the diversity weights that lie somewhere in between. So they still preserve the logic of exposing more towards large caps than to small caps, and that has important risk management implications, as an equal weighted portfolio is generally more risky, more volatile. However, it allows you to limit your exposure to the Apples and Microsofts of the world that would be unavoidable if you just allocate your capital proportional to market caps. And the mathematical logic behind diversity weights is very simple. You pick a number between 0 and 1, and you weight not according to just linear market caps and the relationship between individual stocks market cap and the sum of all other market caps, but you raise it to some power between 0 and 1. And the closer it is to 1, the closer your diversity weights would be to plain value weights, and the closer it is to 0, the closer they would be to plain equal weights. So somewhere in between would be arguably the best of both worlds, limiting your exposure to large caps, but also not overexposing to small caps, and preserving the logic that you allocate more, respectively, towards larger companies. So let's pick a value of P to be in the middle of the road, exactly, at 0.5, between 0 and 1, and let's calculate the sum of our value weights raised to such power. So let's calculate the sum of this column of value weights raised to the power of 0.5 over here. And we get 18.3. And now the diversity weights can be calculated as the ratio between your value weight raised to the power of P, and we'll lock the row here, divided by the sum of all such weights that we have just calculated, and the row should also be locked. And we can see that if you choose the value of p at 0.5, you do allocate quite a lot towards Apple, but it is 1.34% instead of almost 6%, so exposure is quite limited here. And small caps, or relative small caps, there are no genuine small caps in the S&P 500, isn't it? The exposure to them is quite a bit higher than in the value-weighted case at 0.05% instead of 0.01%, but is notably lower than in the plain equal-weighted case at 0.2%, which is maintained throughout your sample. And the P parameter can be varied to model a more close to value-weighted case or a more close to an equal-weighted case. And in the literature, the value that is most frequently used is 0.76. This is just a convention that's used for diversity weights. That would lead to the maximum exposure to an individual stock, in case of Apple, being 3.1%. And just to illustrate the equivalence of diversity weights to value weights and equal weights respectively when P is equal to 1 or 0, we can check this out. If you input 1, then due to this mathematical logic, the sum of weights is equal to 1 because you raise it just to the power of P, and your diversity weights are equivalent to your value weights. While if your P is equal to 0, then the sum of weights is equal to the number of companies, and the diversity weights are all equal and are equivalent to equal weights. However, in a relevant financial practice, do stick with some value of P in between 0 and 1, and the convention is, as I already mentioned, 0.76. And that's all there is regarding the diversity weights developed by Fernholtz. Please leave a like on this video if you found it helpful. In the comments below, I'm eager to see any further suggestions for videos in business, finance, or economics topics you would like me to record. And please don't forget to subscribe to our channel or consider supporting us on Patreon. Thank you very much, and stay tuned.